Hello, and welcome back to this course on business skills for agro dealers. If you are an agro dealer, this course will provide advice on how to achieve your business aspirations, whether you want to grow your successful business, improve a struggling business, or establish a brand new business. In our last session, we discussed the importance of building a budget. But while a budget is good for estimating your income and expenses at a very high level, you also need to keep detailed records of what you actually earn and spend and compare it against your budget regularly. This can help you determine if your budget is realistic and keep you on track to achieve your long-term goals. To that end, today we will talk about what records agro dealers need to keep and how to put together reports like a balance sheet and profit and loss statement. With us for today's discussion are three agro dealers at various stages of their businesses: Mukisa, Damba, and Namazi. Mukisa has been in business for over 2 decades.
Yes, and I have never done a balance sheet, so I am interested in what you have to say.
Damba has been in business 8 years, so a while, but not quite as long.
Good to see you again.
Namazi is in the process of opening her shop.
I am very interested in learning about record keeping so I can do everything right from the start.
Thank you all. Now let's begin. Keeping detailed financial records is admittedly not an activity that most people enjoy, but it is critical if we want to keep our business profitable. Having complete and accurate financial records can help us make well-informed decisions about our business, such as identifying which products are profitable and which are not, ensuring that our prices are set at a point where we are making money and farmers can still afford them, identifying any areas where we might be losing or wasting money so we can take action and adjust our budget accordingly, and determining whether we can afford to make any major investments like purchasing a vehicle or opening a second location. Beyond that, should you ever decide to apply for a loan, the bank will want to see your detailed financial records, typically for about 2 years. So, getting on with it, today we will talk about what types of financial records agro dealers should be keeping, how often you need to update and review your records, and also how to analyze and interpret our records to make better decisions about our business. There are a number of different records agro dealers should keep, specifically a cash book, a creditor book, and a debtor book. So, do the three of you keep all these records?
Yes, in my head.
I used to keep all sorts of records. I still keep a cash book and a list of all my creditors.
I have been starting to keep a record of my inventory as I purchase it, but since my shop is not open, I don't have any other records yet.
Well, that's a start. Let's take a moment to talk about each in more detail. Your most important daily record is your cash book. This is where you write down all the money coming into your shop and all the money going out on any given day. You don't need much to start your cash book. You can keep a little paper notebook, by your cash register, or maybe download a free app for your phone. Whatever you use, the important thing is to record every single time money comes in and out and what it's for. So, what information should we be recording in our cash book each day? Well, first you should record any cash on hand. For example, most of us start the business day with some cash to make change for our customers or buy ourselves some lunch. However much money you have at the start of the day, write it down. Then, record any money that comes in or goes out. Someone comes in to buy fertilizer, write down what they bought and how much they paid. Did you have to pay cash for a delivery? Write it down. Need to pay yourself a little money to purchase some groceries? Write it down and note how much you paid yourself as if you were an employee. Finally, at the end of the day, you should verify the amount of cash you have left. Add up all the money coming in plus the amount of cash you started with, then subtract all the money that you spent. This amount should equal the actual money you have in your cash drawer. If it doesn't, you have likely miscounted or forgotten to record a transaction.
Okay, but what good is it to know if we made or lost money on just one day? I mean, if I am preparing for the busy season and taking lots of deliveries from suppliers, then of course I will have less money at the end of the day. When the busy season arrives and farmers are coming in to purchase inputs, of course I will have more. That's to be expected.
Of course, but the point isn't just to record positive versus negative. It's to determine whether our actual numbers are in line with what we would expect from our budget. If it's a month when we expect to spend more than we make, then it's okay if our cash book is negative, as long as it's not too far negative. But if it's a month where we are expecting to make lots of money but are falling short, looking at the numbers day to day, week to week, can help us determine why. Now, there are other things an agro dealer needs to keep track of besides cash coming in and out. Every business person has larger expenses like rent, big orders from your suppliers, or transportation for your stock, which you aren't going to pay with cash out of your till. For this reason, in addition to a cash book, you must also keep a creditor book. Creditor books are simple. Simply write down any amount you owe, who you owe it to, and the date it must be paid. Likewise, you will need to keep a record of anyone who owes you money, a debtor book. Again, simply write down the amount owed to you, who owes you the money, and the date it must be paid. You should also record any terms you've negotiated with the debtor, such as dates of installment payments with a trusted debtor.
Interesting. Should I expect to have a lot of debtors?
I thought you grew up on a farm. Customers are always like, I am doing some work for my neighbor on Thursday. Can I pay you Friday for some seed today?
If you don't say okay sometimes, you won't have any customers.
Whether to extend a customer credit is a decision you will have to make case by case. But whatever the case, make sure to write it down and confirm that the customer has the same understanding of the terms.
Excuse me, but I have a question.
Please, go ahead.
I recognize how these types of detailed records might be valuable for a very large and successful business. If I had 5 stores and a dozen employees, I am sure I would want to keep records of how much each was selling and spending. But if it's just me on my own, It feels like these records won't tell me anything I don't already know. I suspect my time will be better spent doing something to actually make money.
That's a valid concern that many business owners have. But records don't have to be complicated or take your attention away from earning money. In fact, the point of financial records is to make your life simpler and help you make money. The important things with records is: first, keep them simple. Otherwise, you won't fill them out at the end of the day. Also, keep them consistently. Records won't do you any good if you only keep them when you feel like it. Even during the slow season, you should maintain your records, even if it's just to write that you didn't make any sales that day. Also, keep them neat and orderly. There is nothing worse than trying to make sense of numbers you wrote down months ago when you can't tell what they mean or can't even read your own handwriting. Now, to answer your other question, what is the value of keeping all this information? Well, we can use it to verify that our budget is accurate and adjust our estimates for future months if it is not. We can also identify potential opportunities for increasing profit, as well as areas where we might be wasting money and can reduce costs. As we've mentioned before, banks will definitely want to see this information should we ever apply for a loan. Speaking of things banks will want to see, there are 3 reports that most businesses will create from their daily records: a balance sheet, a profit loss statement, and a gross profit margin calculation.
Great, more paperwork.
I know, but hear me out. Now, a balance sheet is a summary of how much your business is worth at the present moment. It consists of a table with 2 sides. On one side, you list your assets, that is, everything of value in the business. This includes cash on hand, unsold stock, equipment, savings, money owed to you, and land and buildings you own. Then, on the other side, you list your liabilities. That is, any money your business owes to others, like rent, a loan, or taxes. When you have everything listed out, subtract the total amount of liabilities from the total amount of assets. This will leave you with your owner's equity, which is a measure of how much your business is presently worth overall. Not only is having this information useful for you as a business owner, but it is something a bank will want to see before extending credit. To that end, you should prepare an updated balance sheet at least annually or possibly quarterly, whatever makes the most sense for you. Another important report we can create from our daily records is a profit loss statement. A profit loss statement is sort of the mirror image of your budget, but where your budget lists estimated income and expenses for the upcoming month, quarter, or year, your profit loss statement lists all your actual numbers for the past quarter. Comparing your budget to your profit loss statement can tell you if your budget is realistic. For example, perhaps you budgeted a certain amount for your cell phone expenses in January, February, and March. But when April arrives and you prepare your profit loss statement, you might see that your phone bill was significantly more than you had anticipated. In this case, you would either adjust your budget to account for what you are actually spending or try to reduce your spending on your mobile, or both. On the other hand, perhaps you budgeted for a certain type of animal feed to bring in a modest amount of income. But for whatever reason, it proved very popular with farmers and you sold significantly more than expected. In this case, you might want to investigate why it sold so well and if it makes sense, perhaps stock more of it in the upcoming season. Whatever the case, a profit loss statement can yield useful insights, and once again, it is something a bank will want to see if you apply for a loan.
So this is all very simple. Sell as much as you can as fast as you can, do this and your business is profitable.
Not so fast. Just because you sell a lot doesn't mean you are profitable.
This makes no sense.
Well, we will try to explain. In order to determine how profitable you are, first you need to calculate what we call the gross profit, which is the simplest way to calculate profitability. To calculate your gross profit, you must take your total sales revenue and subtract the cost of goods sold. Let's say, Mukisa, that you have a very good day of sales. How much would a very good day of sales be at your shop?
Well, on a good day when the farmers are buying from me, I can bring in almost 14 million UGX.
Very nice. Now, for argument's sake, what would you guess the cost of goods would be?
If I had to guess, let us say 11 million.
Very good. So your gross profit for the day was 3 million. But how profitable is your business exactly? For that, we can calculate your gross profit margin, which is expressed as a percentage. To do this, take your gross profit and divide it by your sales revenue. So 3 million divided by 14 million is about 21%, which is your gross profit margin. The higher it is, the more profitable your business. Now let's say our friend Namazi here has also had a busy day, but she has only sold about 12 million worth of products.
Ha! Less than me.
Yes, and Namazi paid 9,240,000 for her goods. Her gross profit is 2,760,000.
Still less than me.
Alright, but now we calculate Namazi's gross profit margin and find that it is 23%. Namazi's business is more profitable even though her gross profit was less than Mukisa's.
I like the sound of that.
Having detailed records can tell us where you are making money and where you're losing it. Then we can make some adjustments to our business to improve profitability. For instance, we might raise the price of a product that is popular with customers but not very profitable. Discontinue products that do not sell. Look for patterns in our cash flow. Identify expenses you can cut out. Or, if you have extra money, see if there are any ways you could invest it back into your business. Okay, it seems we have reached our time for this session. Whether your business is thriving or struggling, keeping accurate records can help you monitor the health of your business, identify ways to improve your profitability, and once you address any issues, prove to a bank that you are credit-worthy should you ever need a loan. While it does take time and effort, think of record keeping like exercising a muscle. If you do a little bit every day, your business will be strong, healthy, and profitable. But you have to do it correctly and consistently. Otherwise, you will never realize the benefits. Before next time, take a moment to review any records you currently keep. If you don't keep records, Develop any templates you might need. Remember, these do not have to be complicated. Decide whether you are going to compare your budget to your profit loss statement monthly, quarterly, or yearly.